In just a few days, the Federal Reserve is going to make a decision that will directly shape your debt, your savings, and honestly, your next big purchase. And here's the kicker. For the first time in well over a year, almost nobody thinks they're going to make things cheaper. Welcome to The Explainer. I am absolutely thrilled to guide you through this today because, look, we are sitting at a massive pivotal moment for the economy right now. If you've been waiting for the cost of borrowing to finally drop, or if you've just been sitting there wondering what on earth you're supposed to do with the cash sitting in your bank account, this is literally the exact moment you need to be paying attention. We're going to cut right through all the market noise, we're going to look closely at the raw data, and we're going to focus on exactly what you need to know to protect your money.
Okay, let's jump right into this. As of right now, futures markets are pricing in a 0% chance of a rate cut for the upcoming July 28th and 29th Fed meeting. Zero. Nothing. Zilch. I really want you to just stop and think about that for a second, because if you rewind just a little bit, there was so much talk earlier this year about rates coming down, right? It felt like a sure thing. But now, the market has completely, 100% wiped that possibility off the table for this specific meeting. So today in this explainer, I am going to break down exactly what is actually on the table at the Fed's next meeting. We'll look at why a rate cut is basically off the table for the first time in a really long time, what specifically changed to get us to this point, and most importantly, I'm going to give you a playbook, 5 practical, actionable steps to position your money before the decision even lands, so you aren't stuck just reacting after the fact. So here is our roadmap for today. Part 1, the July Fed decision. Part 2, why expectations flipped so violently. Part 3, stopping the cycle of reacting so we can start positioning. And Part 4, those 5 practical steps you can take today.
All right, Part 1, the July Fed decision. What is actually on the table? So, working from our current baseline federal funds rate of 3.50 to 3.75%, the real debate right now isn't cut versus hold anymore. That debate is completely over. It is entirely hold versus hike. Looking at the futures markets currently, they see roughly a 75% chance that the Fed holds steady and about a 25% chance that they actually raise rates. Now, I know 25% might not sound like a guarantee, but a 1 in 4 chance of a rate hike is an undeniable, massive shift in sentiment. If a meteorologist tells you there's a 25% chance of a torrential downpour, you don't leave your umbrella at home, right? You prepare for it. We absolutely have to treat a hike as a very real, very tangible possibility here, not just some theoretical edge case risk. The market is taking it seriously, and so should we.
Moving to Part 2, why expectations flipped. How exactly did we go from anticipating cuts to bracing for hikes?
To understand this, we really have to look at the contrast, because the whiplash here is just incredible. Think back to late 2025. The Fed actually cut rates 3 separate times in the second half of last year, bringing the federal funds rate down to the current range we have today. And going into this year, pretty much everyone from Wall Street analysts to regular folks expected that cutting cycle to simply continue. The general consensus was basically, hey, the inflation fight is won, let's start bringing borrowing costs back down to earth. But instead, inflation came in incredibly hot. It was stubborn. May's readings slapped us with a 4.2% annual increase on the Consumer Price Index. And if that wasn't enough, the Fed's preferred inflation gauge, which is the core PCE, also came in well above its 2% target. It hit 4.1% overall with a 3.4% core reading. That single, incredibly stubborn shift in the inflation data completely derailed the rosy narrative. It was like a bucket of ice water on the market. It flipped the entire conversation around interest rates on its head, moving us instantly from expecting cuts to actually bracing for hikes.
And adding a whole new layer to this dynamic, the Fed also has a new chair, Kevin Warsh, who ran his first meeting back in June. And wow, the updated projections from that meeting really told a story. They already raised the median year-end rate forecast for 2026 all the way up to 3.8%. For context, back in March, that projection was sitting at 3.4%. So that is a huge jump. Right now, 9 out of 18 Fed officials are projecting at least one rate hike before the year is completely over. 9 out of 18. That is exactly half the committee. If you rewind a year ago, telling most market watchers that half the Fed committee would be pushing for a hike would have sounded absolutely ridiculous. But right now, it's the base case for a real significant share of the people actually in the room making this decision. They aren't hiding the ball here. The people turning the economic dials are telling us exactly what they're looking at and where they think this is going.
Which brings us to Part 3, stop reacting, start positioning. This is all about the mindset shift you need to make right now.
So I have to ask you, are you reacting or are you positioning? Because here's the reality of how this usually plays out for the average person. Most people only react to Fed decisions after they happen. They react after they get that email saying their credit card rate just spiked, or after their new mortgage quote jumps unexpectedly, or after they notice their savings account rate quietly shifting. It's like trying to go out and buy an umbrella when you are already standing in the middle of a thunderstorm getting soaked. By the time this stuff actually shows up on your bank statement or in your life, the decision has already been fully priced into everything around you. The penalty for being late is already hitting your wallet, and you're just finding out later than everyone else. But the people who come out ahead in these volatile moments, they don't do that. They position ahead of the news. They look at the exact data we just reviewed, that 75% chance of a hold, that 25% chance of a hike, that uncomfortably sticky 4.2% inflation, and they make their moves based on what's already the most statistically likely outcome. They do this proactively so that when the actual decision drops, it just confirms a plan they already put in motion, instead of forcing them into this stressful, expensive scramble to catch up. Positioning puts you firmly in the driver's seat of your financial life. Reacting just leaves you completely at the mercy of the markets. All right, let's get into part 4, 5 practical steps. This is how we are actually going to protect your money. Here is a quick, high-level overview of our playbook, the 5 practical steps. We are going to tackle variable debt. We'll talk about optimizing your cash savings, rethinking your timeline for any big purchases, why you need to completely update your financial assumptions for the year, and finally, how to actually decode the Fed's language. Let's break these down one by one, because I want to stress this. Every single one of these steps is something you can take action on right now. Okay, step number 1, do not wait around for a rate cut to pay down your variable rate debt. Look, with a rate cut essentially totally off the table, as we saw with that literal 0% probability, and a hike being a very real live possibility, carrying high-interest variable debt into this July meeting is effectively a massive bet against the most likely outcome. Every single day you carry a balance on a credit card or a variable rate personal loan, you are paying a hefty premium. And here's the thing about variable debt. If the Fed hikes rates by even a quarter point, your credit card company isn't going to wait around. They are going to pass that increase directly onto you almost instantly. Boom, your borrowing just got more expensive overnight. Paying down this specific type of debt right now is arguably the absolute safest, highest return move you can possibly make, regardless of which way the Fed ultimately decides to go on July 29th. Whether they hold or hike, paying down double-digit interest debt is guaranteed risk reduction. It is a no-brainer. Step number 2 is all about your cash. You need to take advantage of high-yield savings while it lasts, and you need to be smart about liquidity. If the Fed holds steady, or especially if they hike, the rates on these accounts are going to stay incredibly attractive. A high-yield savings account keeps your money completely liquid, meaning you can access it whenever you want, but it also keeps it positioned to automatically benefit if rates move up. Literally, if the Fed hikes, your high-yield savings rate will likely just float right up with it without you having to do a single thing. On the flip side, locking your money into a long-term certificate of deposit, a CD, right now means you are fixing your rate at today's numbers. And honestly, locking in your money only makes strategic sense if you heavily expect rates to fall meaningfully and soon. Because if rates fall, you're happy you locked in the higher rate, right? But as we have clearly seen from the Fed's own 3.8% projections and the stubborn inflation data, rapid rate cuts are just not the current outlook. If you lock all your cash in a CD today, and the Fed actually hikes next month, you are going to miss out on the extra yield you could have had. So for right now, the play is to keep your cash liquid and nimble in a high-yield savings account. Step number 3, delay large, rate-sensitive purchases if you have the flexibility to do so. We're talking about anything financed: a new car, buying a home, or taking out a loan for a massive home renovation project. All of these things get fundamentally more expensive to borrow for if a rate hike happens later this month. Now, a lot of people have this natural psychological reaction where they think, oh no, there might be a hike, I need to rush out and buy this thing right now before rates go up. But that's usually the wrong move. The reality is that the bond markets have already priced in a lot of this current anxiety into mortgage and auto loan rates. But more importantly, if your big purchase can reasonably wait just a few weeks past July 29th, you will be making that massive multi-year financial decision with actual 100% confirmed information instead of just making a guess under a cloud of uncertainty. You will know the Fed's exact stance. You'll know exactly where the chips fell. And let me tell you, having that absolute certainty is incredibly valuable when you're about to sign your name on a massive loan agreement. Don't rush, wait for the data to clear. Step number 4, you need to revisit any financial plan you built that assumed rates would just keep falling. Let's be honest, a lot of us did this. If you sat down earlier this year and built a household budget or a business plan or an investment strategy, and your foundational assumption was that the 2025 rate cutting cycle would just happily continue all through 2026, this is the exact moment you need to open up those spreadsheets and update that assumption. Planning around a higher for longer environment, instead of assuming rates will keep dropping,
completely changes what the safer moves look like. It changes how much house you can truly afford to borrow for. It changes how you forecast your business's expansion expenses. And it totally changes the threshold for what makes a good return on an investment. Take an hour this week, grab a cup of coffee, look at your numbers, and simply change the assumption to higher for longer. See how your plan holds up. It might save you from a major miscalculation.
And finally, step number 5, pay close attention to the Fed's language, not just the headline rate number itself. This is honestly perhaps the most sophisticated, next-level move you can make as someone who follows this stuff. Even if the Fed holds rates completely steady on July 29th, which again is the 75% probability right now, the actual tone of their official statement and what Chairworsth says in the press conference afterward, that often signals what is coming next far more clearly than the immediate decision itself. In the finance world, we call it Fed speak, a hold that sounds like they are extremely worried about inflation and are basically setting up a hike for the fall. That's a hawkish hold. That is a very different economic signal than a dovish hold, where they suggest they are perfectly satisfied with the current progress and are just waiting things out. The specific words they use, the adjectives, the tone, that is what will move the markets instantly, while everyone else is just looking at the top-line number.
Which leaves us with this final, absolutely vital question to keep in mind. What will the Fed's tone really signal on July 29th? When the news breaks, I challenge you. Don't just read the headline rate on a news app and close your phone. Actively listen to the press conference. Read the statement. Pay close attention to exactly how the committee describes inflation and the broader economy. Because if you followed these steps, you are no longer just reacting. You have already positioned your money, you've optimized your savings, you've handled your variable debt, and you are totally prepared for whatever comes next. Thank you so much for joining me for this explainer today. I highly encourage you to put these 5 steps into action before the 28th rolls around. Stay focused, trust the data, and keep learning. I'll see you next time.